Have you ever stopped to think about how a conflict happening thousands of miles away could actually change the interest rate on your mortgage? I know, it sounds kind of crazy, right? But today, we're going to trace those invisible lines that connect global events right to your local housing market. Okay, let's get into it. Just a few weeks ago, everything was looking up for the spring housing market. It was incredibly bright. If you were a buyer or a seller who'd been kind of waiting in the wings, it really felt like, okay, this is it. This is the moment. There was a serious buzz in the air. And then, bam, it felt like it happened overnight. All that optimism just hit a brick wall. A conflict on the other side of the world sent these massive shockwaves through the global economy. And yep, the US housing market got caught right in the middle. So how did we go from this perfect setup to a market stuck in limbo? All right, so let's start by rewinding just a little bit to see exactly how good things were looking and then how fast it all changed. Okay, so check this out. It wasn't just one thing. All the signs were pointing in the right direction. We had 10-year Treasury yields, which is a fancy way of saying the interest rate the government pays on its debt, and it's a huge driver for mortgages. They dropped below 4%. And that helped push mortgage rates below 6%, which was this huge psychological boost for buyers. Plus, people were making more money. More homes were actually being sold. And get this, we were finally seeing more houses come on the market. It was like the perfect recipe for a crazy busy spring. One of the sources we looked at used this incredible metaphor. They said the market was a supernova of excitement, just ready to explode with activity. But this new reality became a black hole, just sucking all of that positive energy, all that momentum, right into this void of uncertainty. And this quote from economist Jeff Tucker just nails how fast things went south. He says, "We kind of had a good thing going there for about a week." A week. And now those stars just aren't aligned anymore. It's a feeling you're hearing from experts pretty much everywhere. So what was the very first domino to get knocked over? Well, it all starts with something we watch every day, the price of oil. 40%. Just let that number sink in. That's the jump in oil futures since the conflict kicked off on February 28th. We're not talking about a slow, gradual increase here. This was a massive, sudden jolt to the world's energy market, and you feel the effects of something like that almost immediately. And here's where it stops being an abstract number and gets really, really real for all of us. The average price for a gallon of gas just shot up from about $3 to $3.60. This is a direct hit to your wallet every single time you fill up your car. And like George Otio points out, this isn't just a big city problem or a coastal thing. It is literally everywhere. The fact that you basically can't find gas for under $3 in any state anymore, well, that really shows you just how widespread this first hit was. Okay, so the first shock is at the gas pump. But that's just the beginning. Now let's trace how that ripple spreads through the entire economy. It's a pretty simple, but wow, is it a powerful chain reaction. First, it costs more to put fuel in the trucks, the trains, the planes, the ships, everything that moves stuff around. So that means shipping costs go up for businesses. And what do those businesses do to make up for that cost? They have to charge more for their products. So a spike in oil prices leads directly to higher prices for, well, everything. That's inflation. This quote really gets to the core of it. Oil isn't just another product. It's the foundation for almost all of our economic activity. Think about it. From the plastic in your phone to the Amazon package that shows up at your door, modern life just runs on oil. And that's exactly why a price shock is felt everywhere. Now, I know when you hear oil crisis, your mind probably jumps straight to the 1970s, right? The gas rationing, those super long lines, but experts are quick to point out a really big difference this time. While we're definitely feeling the pain at the pump, the US produces way more of its own oil now. That domestic production acts as a really important buffer that we just didn't have back then, which makes a full-blown crisis like that pretty unlikely. So all of this economic chaos, the inflation, the uncertainty, it puts one group in a very, very tricky position, the US Federal Reserve. And that is the million-dollar question, isn't it? It's what every economist, every investor, and probably a lot of us are wondering right now. The Fed had a game plan, but a global crisis like this can throw a giant wrench in the works. So here's the deal. The Fed is basically caught between a rock and a hard place. On one side, you've got prices for gas and goods going up, which is screaming at them to raise interest rates to cool the economy down. But on the other side, if they raise rates too much or too fast, they could slam the brakes on the whole economy and hurt the job market. It's a tough spot. And this quote from Odetta Kushi just sums it up perfectly. It's a balancing act. They're trying to walk this incredibly fine line. And right now, that tightrope they're on just got a lot higher and a whole lot shakier. Okay, we've talked about oil, inflation, the Fed, a lot of big picture stuff. But let's bring it all back home. What does all this actually mean for you if you're thinking about buying or selling a house this spring? Now, this is a really, really important point. Everybody is watching the Fed, but if you want to know where mortgage rates are headed, the 10-year Treasury yield is a much better crystal ball. And here's the interesting part. Despite all the chaos, those yields have actually been relatively stable. That's a huge piece of this puzzle. And let's also put the current rates into perspective. Yeah, they've gone back up to around 6.1%, and that's a bummer after they dropped for a bit. But that's still way below the peak we saw in 2023, which was almost 8%. So context here is everything. And, despite all these headwinds, experts say there are still real reasons to be hopeful. For one, sellers might be more motivated to make a deal after 3 pretty slow years. And more importantly, the real reasons people buy houses, getting a new job, having a baby, life stuff, that doesn't just stop. The market might be a little slower, but it's not going to grind to a halt. And that really brings us to this final thought from George Rachu. Even with all the craziness and all the uncertainty, the basic ingredients are still there for this spring to be a really good opportunity for a lot of people. It might not be that supernova we were all hoping for, but it is absolutely not a lost cause. So we'll leave you with this question to chew on. The story of this spring's housing market is just a massive reminder that in the world we live in today, something that happens on the other side of the planet can show up uninvited right at your front door. It really makes you wonder, doesn't it? Is any market ever truly just local anymore?